on camera.
Hey, Tim, I have a question.
Fire away, Tim.
Since
Yeah.
you have 5 things, would
Yes.
it be would it be helpful when either the Candidly email comes out as a reminder or whatever that you
Yeah.
list? I mean, if you have a set agenda, I understand that you may not
Yeah.
a lot of times, but if you do,
Yeah.
maybe putting them in there so that we can actually be thinking about that when we have a call.
If I could get it prepared soon enough, I would do it, Timothy. It's the only rub is I don't, I try to block the half hour beforehand. I have a pretty good idea what I'm going to cover, but that's generally when I prepare. That's the trouble, and so I would have to think ahead to pull that off. And it's an idea, and I appreciate your thinking, because then you can say, "Well, I'm not sure I want to spend my time on that." You can decide whether to come. I'll make a note of it, and I will try. It remains true that because I'm not that smart, I'm pretty well tapped out most of the time. So, but thank you. It's a good idea. It is a good idea. And by the way, I know that we are having issues with, if you've encountered this, with the Market Structure Edge homepage. It's not affecting the app. It is affecting the homepage. And if you didn't know, maybe I should have just been quiet. But the trouble is, Microsoft. So we're very Microsoft centric, for better or worse. I mean, it's just what we've done. And they changed a network connection requirement overnight, and we use MySQL to operate some stuff on our homepage, and that stuff stopped transporting back and forth. And we're resolving it, but it's been more challenging than I would have thought. So they tell me that they're going to have that done pretty soon. And this change, we knew it was coming. It was supposed to be in 2024, and overnight they flicked the switch. I get it. Microsoft has a lot of. Did you know that just this year, the ratio of people on operating systems later than Windows 2007 finally tipped to the majority? So trying to support all that crap is difficult, and I get it. So anyway, if you hadn't noticed, never mind. If you did, we're working on it. Okay, now let me get to the things that I have, and we can get to what you'd like to as well. I'm going to share my screen here. Let's see. Okay. All right, so this, if you haven't seen it, this is the dashboard. That's a Microstructure Edge dashboard. Whoops, let me go back over here. Okay, there, I think we're in. And I just want to, why am I not seeing that? Am I missing? Oh, I see what I'm doing wrong. Go. Okay. Ian, you're in, and you haven't missed anything. Just getting started. Okay. So, and I try to keep these to, as you guys know, 35 minutes. If I can do it, that's the aim. So we're very respectful of people's time. Again, if you just joined, mute yourself at the beginning, if you would, and then ask questions anytime that you like, and you can do that by chat or just interrupt me. So this is not a trick question, but feel free to weigh in. What sets the price of stocks? As from Ferris Bueller's Day Off, Ben Stein, anyone. It's, and you could say, well, supply and demand. I mean, that's the core of Market Structure Edge. And if you were about to answer, it's the offer. So the whole stock market is built around the bid to buy and offer to sell. That is the system in the stock market under the regulations that govern it. And so the offer to sell is always the price that prices the market. This is why exchanges, the NASDAQ, the NYSE, which operates 5 different platforms, SIBO operates 4, there are 5 different independents. A lot of them, most of them will pay traders to set the offer. That is called furnishing liquidity. You don't furnish liquidity, you just offer stuff for sale. That's what furnishing liquidity is. So the offer is very important. And the reason I mention this is it's very important to understand how stock prices are set. And they're set by first the offer, which will always be higher than the bid, maybe by, you can only quote in penny increments, but trades can occur in fractions of that because somebody will cross the spread, it's called, move somewhere between the bid to buy and offer to sell and match your trade. And you will see that if you use limit orders, that if you take it at the market price and it's a small trade, you will probably get a little better price than what's listed, because somebody will get in the middle that they will have bought it by a tenth of a penny cheaper and then sell it to you for a tenth of a penny more. That's what's really occurring there. Let me see. Let me let one more person in here. And I mentioned that as a precursor because it explains why the stock market goes up and down. I talk to public companies about this all the time. Would that it were that your story, your fundamental performance, your financials, your management's expertise, your differentiation in the marketplace, that those things would set your price. But the truth is, what sets your price is the offer, and then how close the bid gets to it, and if there's a bid. And if there isn't, price declines. It will always decline, all other things being equal. Unless demand is greater than supply, price falls because the offer is higher than the bid. And so whoever buys is going to pay a little less than the offer. Well, if it isn't, there's no one there, price will decline. That's why we measure supply and demand. It's a very important and yet basic principle. And you could run up to somebody breathlessly on the street and blurt out, how are prices set in the US stock market? And probably not 1 in 10,000 people, maybe not 100,000, could answer that. But that's your lesson for today. If you take nothing else away, the offer is what prices the market. And whether it's sustainable depends on the bids. And it seems complex jargon, but there's a very simple, that's the whole basis of how the stock market works. So this is why, here's the lead in, this is why it's so challenging to trade things during options expirations. We talk here at Edge about broad sentiment, which is at 4.7, so there is insufficient demand at present. I think it's going to bottom pretty soon based on the rate of decline, and I'll click through it in a moment. So broad sentiment, what's happening in the broad market? Is there more money coming in than leaving, or vice versa? I guess I covered them both there. And supply associated with that. Context, what is occurring in the cadence and calendar of the market? And today, our index futures and options expirations, actually, they expired at noon. Notice what the market did? It was up about 400 points till those things lapsed. Then, boom, down it went. Now, you could hunt around for some other correlation, but that is the true correlation. The others are false correlations. It's a very big deal in the market when those things reset. Now, I'm not saying that the market can finish up. I don't know where it'll finish today because of the fact that the bid and the offer are being determined by things that are unseen. They're the counterparties to derivatives. The thing with a derivative is there's always somebody on the other side. There is in a stock trade too, but it could be the same parties over and over. In a derivatives contract, this will come to a conclusion, and then it begins again. So tomorrow we have triple witching. So rather than the full stock and index options and futures trading, they're only stock options and futures. And there's something else in there. I can't remember, I've forgotten because I'm getting old. I've forgotten about those things. But that's what's happening tomorrow. And it's still very important. It's not just quad witching that matters. It's these monthly resets. And it becomes difficult to know what stocks will do, because you can't see exactly what the commitments are. And I'm going to take you through some examples with companies. What are the best performing stocks today? A number of them reported results. And I want to show you the supply and demand and what you can know to the best of our ability. But it becomes less certain during options expirations because of the fact that it's like a black hole. We can see black holes only by the fact that light bends around them. You can't observe it physically. Well, in some sense, derivatives are the same way. They're things that you can't quite see. So this is why we're very cautious about the context and how these things can change outcomes, as can earnings, because there are big bets, particularly beforehand. But we say the 2 weeks before and after, these are very important things for hedge funds, and it may have more to do with what the response to the market might be, or whether they can just outlever the market with sheer size, and it can affect outcomes. So the rest of the time, it's easier. So earnings occur 4 times a year. Yeah, it stretches out over a period of time. but it kind of concentrates in about a 3-week period, and then options expire. Basically, there's a, I think 5 days. There's Wednesday, Thursday, Friday, tomorrow. New options trade on Monday. Counterparties square the books on what expired and what began trading on Tuesday, and then you're kind of in the clear. And you say, well, that takes out a lot of the year. Not really. I mean, the time is risk. The more time that your trades are exposed to the market, the better the chance that something happens that you don't expect. So all we want to do is make money and not lose it. And look, I'm going to talk about, I always share everything with you guys. I'll tell you what I'm doing well and what I'm not doing well. And it's always my fault. It's not the math's fault. And I'll give you one case in point. But that's why these things matter. So you have to beware that during this period of time, it's more dangerous to trade things. I prefer not to be trading things during expirations for that reason. It's a lot better. And you say, well, what if I miss an 800-point move? Who cares? All that matters is what is your trading account and are you increasing it? And we want to maximize the probability that that occurs. And we know that if we follow broad sentiment, context, and the last thing, divergence, supply and demand separating in a favorable fashion, that's the best way to go. Okay, these examples I want to get to, and that, by the way, is item number 3. So item number 3, examples. Here's what, maybe I'll just go to this just because it's an example I used today in the market desk note. I said, okay, well, here's an example of the kind of divergence that we like. Now, whether that works out during options expirations is much less probable than it is when it's not. I mean, if broad sentiment is rising and nothing's going on and we have this condition, the probability that you can get a return on a stock like this is very high. There are some knocks on it. I would call it a small cap. It's got a higher, less than 10% spread between the bid and the offer. So I would buy it at the market, 99 shares at the market, because that's not enough to make a difference to me. This is good, falling supply, demand on a nice ramp, maybe price down a little bit. Well, the probability is very high, all the things being equal, that this stock rises, so long as associated options aren't expiring and it's not reporting results. And both of those are possibilities. I didn't look up when they're reporting. That's very easy to do, though, by the way. All you have to do is go out here and go to, just type in, this is what I do, earnings calendar, and I use Yahoo's. I mean, you can use anyone. It's a free service, right? You might as well. And all you have to do, if you haven't done this before, is just as it spins, type in a ticker in the search box and find out when they report results. Everybody's trying to do that right now. May have to come back to that. Oh, here we go. Okay, so here's all I do before if I'm going to trade something during this period of time, I'm going to check to see when is it reporting. Well, according to this, it's reporting before the market opens on November 1st. Okay, well, I know that that's a little ways off. It's that simple, so you don't get caught out by something. So let's go back and continue the example. I think the best performer in the S&P 500 today is LRCX, in the semiconductor equipment company, reported results. Here's what you can know beforehand. It's always, it's risky. Would I trade this? No. But you could know that it probably has a chance to rise, and here's why. So this is demand and this is price. It's got lousy demand. It's rarely, demand was over 5 only here in the last 30 days, and supply was way too high. Supply was 69% of trading volume. Well, the probability that produces a rising price is a number approaching 0. I'm not going to trade that. And you'd say, well, but they diverged. Yeah, but that's way too high. There's a point here where it's below trend and below 50%, where maybe now you can get some gains, and sure enough, you did. Just one little tick up here. But here's why it rose. Demand's at 1, so if there's any demand, demand's going to increase, and supply is below trend. I don't like that. I would much prefer demand above 5 and supply falling, but that's the reason that LAM is up today. Is it sustainable? Well, we can look back and say no. If you're in LAM and it's up 6% today, you should take those gains. because options expire tomorrow. And we don't know, we know the bets were long ahead of earnings because there's a supply deficit relative to what the trend has been and what the trailing conditions were. That's a pretty good indication that hedge funds bet long, but it will be very short. And it could give up those gains again because we can tell that the demand equation is not great. So does that make sense? I'm going to give some more examples like this. And again, interrupt me at any point. Okay, so let's look at AT&T. Again, I just want to look at why it's done well. I think maybe second best performer in the S&P 500 today. And once again, we can see a similar condition. It has much lower short volume because it is not as short a term vehicle as is Lamb, which will have much higher and more volatile supply. But the same principle applies. Supply fell. It's only at 44%. Broad market's at about 49%. And it's below the trend. Demand picked up right ahead of results. Those have a probability of producing gains. It's telling us, so we don't even have to know what everybody else knows because we can observe their behavior. And so we're seeing that the behaviors in the market that are driving AT&T's price are presuming price is going to rise when it reports results. Again, doesn't mean it will. So, if somebody has some big options position that they let go, the price could tip right over anyway. But this tells us why it was up. How about Las Vegas Sands? Another good performer today. I don't think they are reporting results currently. And you look at this and say, well, why is this stock up? Purely on gambles. It's not a sustainable gain because you look at that and say, well, demand's at 1, and it was a good stock to trade back here. In fact, I highlighted it back at the end of September and said, demand rising, supply falling, this stock could move. But as soon as those conditions reverse, and even, if you left here, you'd have given back all the gains. It's challenging heading into options expirations. Once you get within wind of options expirations, it gets dangerous. But see that big surge in supply, challenging stock. But you can see that it's spent more time above 5 than certainly Lamb has, and it's a kind of a dangerous stock to trade. But this one, the only answer for why this stock is up is options, because the supply and demand equation don't tell us that it should be. And so therefore, that that's the cause. And it's very likely not sustainable. 2 more, and then we'll move on to point number 5. And again, we'll take, I'll take any questions that you have. Let's see here. Is that right? No, number 4. Sorry, point number 4. So Quest Diagnostics, again, another top performer today. And I just want to look at it because it's a different example. This is a big and stable stock. That is something that spends a lot of time at 5, which it does. So all of October, it has been a 5. And then here just recently, supply has trailed. It's still very high. And that's why the price was down yesterday. But you could look at that and say, well, there's a probability that this stable demand followed with falling supply, coupled with falling supply, should produce a gain or could produce a gain. It's less probable during options expirations. But I wanted to point out again that you're going to be able to see most of the time what is the cause. And during options expirations, if there's a situation like LVS, where the supply demand equation don't support it, what's happening. There's a counterparty. Somebody might get suckered into that, but you won't, because you can look at it and say, that is not sustainable. Last one, Carnival Cruise Lines. A good performer today, at least into options expirations, and you can see why. Rising demand, in fact, it popped above 5, supply deficiency, it's flattening out, so probably already the gains that one might get are diminishing, and I would say if you happen to look at that and buy it, and you have 3, 4, 5% today, you should take it. Could it continue? Yeah, it could. That's a pretty big supply deficiency, and it's all the way down here at 36% of trading volume, well below the market. But you immediately can understand why. What things have a logical, practical supply-demand explanation, and 4 out of 5 do. Only 1 doesn't. 80% of them, you could look at that math and say, I can see why that has occurred, and you will know whether it's sustainable. back here at work too. Rising demand, falling supply, some reasonable gains in there. Soon as supply begins to rise, though, the probability that the gains will continue diminishes. And as soon as it ticks up, that's a good time to leave. So I'll tell you, the thing that I did here recently that I'm not happy about. Now I got to write it out, and maybe it gets worse, maybe it doesn't. But Laredo Petroleum, I could look at. I've still got shares of this, and I should have left. So I don't get it right all the time. The math tells me, so I bought it about here, and already that probably wasn't great. The fact that that the demand line flattened out, it didn't go wham right to 10. I saw that and I thought, am I too close to options expirations to do that? Maybe, maybe. And then the next day supply ticked up. That's when I should have just left, right? Just right there. And it moves enough that I'd gotten out at the same price I got in. That's not what I'm after. I'm after 2-3%. But I didn't do it. Then I went up to Steamboat. We had, friends in town, and, demand's falling. And I look at it and go, oh, now I've blown it. I'm in options expirations, and so demand's fallen all the way to here. Prices deteriorated to 60. Supply is rising. Terrible, terrible conditions. So what do you do if you're exposed to that? Well, if you absolutely have no choice, then you get slaughtered and you have to sell it. I'm not gonna. I now will wait for the next cycle like this, which will come. Do I think that oil is generally a good place to be? You can make all the cases for and against that you want. I mean, the dollar's pretty strong. It's weaker now. The government in the UK is changing. That will result in a slight weakening of the dollar. That tends to boost energy. I don't factor those things into my thinking about trading decisions. Supply and demand determine my trading decisions. That stuff, diverging supply and demand, is what does it. And that, of course, I'll look at broad sentiment. I'm going to look at the energy sector. And oil did very well yesterday. I think that the index options and futures that pulled it down a little bit today could be up again tomorrow. I don't know, but I'm not concerned about being exposed to energy generally right now. So I'm going to wait now, but I'll have that capital tied up waiting for the next supply demand divergence, because you don't want to buy high and sell low. That's exactly the opposite of what we're trying to do. So the only thing now, I double my risk, because I have to wait for the next cycle, and I have to assume, and you know what assuming does, that the supply demand curve will change and that money will return to energy. Now it may not. So I may have to swallow that that loss, but it's a great case in point, because most of the time, and I kid you not, 95% of the time, what I buy and sell works out fine. Every now and then, I make a mistake like this. I should have left when the math said to leave, and I didn't do it. That happened before, as you longtime users know. With Netflix back in January, when I went off on a sailing trip with the limit order in and shouldn't have done that, my fault. I did it with Steris, STE, back in September. I got too close to options expirations. Wham, I got hit by that. The rest of the time, I'm making money very steadily, low risk. So those three mistakes were mine. They weren't the math mistakes. They were my poor decision making. And that's generally the case for us. If we're very disciplined about broad market sentiment, and I'm going to go to that, and context, what's the cadence and calendar of the market, and divergence, and being patient when those things are not working in our favor, we're going to do very well. And if we don't take those kind of precautions, then we set ourselves up for greater risk. So here's broad market sentiment. It peaked at 6.1. It's falling. There was a clear indication for me, right? I even say the statistical probability of further gains for the market when broad sentiment is over 6 is 0. Okay, so why would you buy something then? So it's my own fault. I bought Laredo. Supply is at a deficit here, and I think that demand will probably bottom around 4, maybe a little better. So maybe it ticks up next week. But if supply returns to rising and we have a very weak top, we're not going to get much. I'm not saying that's going to happen, but weak tops precede drops, and we've had 2 of them. These are both fairly weak tops. This is a good, strong top, and it creates momentum. But we know We know right at options expirations and demands has been at this levels over 6.0 for a long time. We should be out of the market, right? We know this is likely to happen, that the market's going to decline. So now with Laredo, I've got to ride this out. I'm going to have to ride out the hurricane. But the better thing to do is to not do that. So there are a whole bunch of examples for you, good and bad, and let me open the floor and fire away. Ask me anything that you want. I can keep talking, but I'd rather take your questions. Barry, you've got to have something for me.
Today, actually, I don't. I've not been following the markets too much because I knew we were coming into expiration and vacations and stuff. I've just been kind of watching the market from afar.
Okay. Well, that was a wise thing to do. Juan, to your question, 90% accuracy. What I mean is over 9 out of 10 times when I trade, if I follow those principles, I'm producing a positive return and avoiding losses. That's what I mean. So it's not a statistic. It is a fact from my own trading activity. And I'm a fairly active trader. I use interactive brokers. I pay commission so I can see where my trades occur. I sold some KDP yesterday. I held that, I held it a little bit longer than I preferred, but I paid the commission and watched how traders took my trade and priced the market with it. I've talked about that before, but that's what I mean by accuracy. Gain, what I'm after. So that's a great question. I'm going to take you to Edge to point out volatility. To me, this is very important. In fact, let's just use Laredo as an example, which is not an easy stock to trade. It's in the energy sector. It's probably in other things too. I'm going to use the energy sector here. This is the portfolio view. So what I did is I'm looking for LPI and portfolios. Sometimes that takes a little bit longer to load. So here's what I mean, Juan. So I'm going to pull up LPI, and it's got a lot of volatility. So it moves 7% on average every day between the highest and lowest intraday prices. That is a great read on volatility. And so the percentage return that I would like to see goes back to that. I'm happy if I get a 2 or 3% gain on a position that I can take gains, not chances, and then wash, rinse, repeat. It's very effective. I make thousands of dollars doing that. When I don't do it, that's when things are more challenging. And sometimes it's really good. I've traded LPI very successfully before and made intraday volatility. So if LPI, here's how I think about this. If LPI has diverging supply and demand, and the context presents no immediate threat, not during earnings seasons or earnings season or options expirations, and broad sentiment doesn't indicate an impending decline, and LPI is down 3%, half of its intraday volatility. This is higher now than recently. Boy, is that a great entry point. I'm going to buy that and in size because there's a high probability in the next 2 days that I make 3%, maybe 6%. If it goes up its full intraday volatility, and then I have an expectation of how price should move. I don't look at the market, and if it goes down additional, if I buy it and it's down 3% and it goes down 5%, am I concerned? No, it's well within the expected volatility. I know it can very easily move that much. Maybe I even add to the position, but that's how I determine my return. So the part B of the answer is let's go over to big and stable and use an example of much lower volatility. Big and stable are stocks that tend to spend a lot of time at 5 and have very little, they're not going to have much volatility. So if I look at Walmart here, Walmart moves 2% a day, well less than the S&P 500 on average, which is over 3%, believe it or not. So if it's at 5 and the stock's down 1% and it's kind of a volatile day and it's had declining supply, boy, that's a great time, all other things being equal, for me to buy it because I might make 2%, maybe even 1% is fine. 1% in a market that is falling is a fabulous return. So that's how to think about it. Otherwise, how would you know how much a price should move? You know, you could say, well, I use technical charts. Well, as I often say, how many rich technical traders do you know? It's not very good. So that's my answer. Yes. Chris, how do you look for opportunities to short a stock? Ooh, okay. That is more challenging. How do you use this tool? I'll come back to you, Joe. So how do you look for short opportunities? So you can do this. I think, we have not studied this heavily. We've done a lot of study on the significance of diverging supply and demand and how well that works to produce returns. I have a short portfolio, but I don't think because I don't short stocks, I don't know enough about it. I have spent 60,000 hours of my life on market structure, 85,000 hours in the US equity market. So I know this, I consider myself an expert on those things. I'm not an expert. I'm not even call myself an expert trader. I'm expert on market structure. I'll become one. On shorting, I don't know anything. So that's my qualifier, Chris. But here's how I look for it. So a short portfolio, it's only got 2 in it right now, is I think I could do better. Here's what I think mathematically, and we'll come around to studying it so that we can support it, that I think this is too high. The mechanics I have set up in this short portfolio say that these are the criteria we want to look for. Dollars per trade over 5,000, very liquid stocks, supply 60% and rising. So the trend up, either 60% or more and rising, demand 8 to 10, but falling. I think that's too high. I think it would be better to short stocks that are 5s and becoming 4s. And falling. Because if you have excess supply and insufficient demand now, those are your probable best shorts. Now, remember, be very careful during options expirations. And I had somebody send me a note. They made a ton of money on the long side of Atlassian, ticker team, and then shorted it. And of course, the stock zoomed during options expirations. And I said, I think you're going to be fine, but you got to be really careful during options expirations because you can't see what somebody might do to you in a day. And look at how much this has been covered. I mean, if you're short this stock, you should be out of it because it's got insufficient supply and it's right at 1% demand. But I think that is the principle. If you could find demand that is falling below 5 and you have supply like this, the probability mathematically that the price declines is very high. That's what I would do. But I'd need to study it a lot more. So, not gospel. Time frame, 2 to 3 days, Juan. That's what I'm looking for. Doc, does that factor into your decision of when to? It's a very good question, Ross. So Ross, if you can't read that, he's saying, does the behavior matter? Well, technically, yes. But and here's what Ross means. How are we doing time-wise? Okay, we can take one or two more questions. So here's what we mean. If you look at I'm just going to go in airlines and cruise ships here, and you'll see that there are 4 key behaviors that can set price. The stock market is driven by 4 demographics. Stock market is a grocery store. There are demographics in the customer base that are focused on story, active stock pickers, characteristics, so passive money, far and away the prevailing investment behavior of the day. In fact, active stock pickers have had 15 years of net redemptions. They don't have more money to deploy, they have less. That's why story has become more and more disconnected from the way the stocks behave. So you can't do what Jim Cramer says and just roll up your sleeves. Let's go find great companies that are better than all the other companies, and we'll buy those, and they'll outperform the market. That is not a likely outcome. It is not a consistently true outcome because of the demographics of the market. So third is fast trading. That's trading price. And the machines are far better at trading price than you and I are because they're embedded in all global markets. They're in 220 global markets. They're buying retail flow. Their servers are right next to the exchanges. They're paying the most for data. They have better data than we do, and they're paid to set prices. Well, how can you compete with that? You can't. I'm telling you, you cannot compete on price with fast traders. They know way more than you do. And then fourth is derivatives, what we call risk management. The interplay of those behaviors determines price. So would you say if fast traders are the leading price, should your time frame be shorter? Technically, yes. But it's so complicated to try to say, well, could I get an incremental better return? If I look at this and say, okay, JetBlue is being led by fast trading, ergo, if it's up, I'm out in 1 or 2 days. Versus Carnival Cruise Lines led by passive money, they're going to have a 5-day cycle. Yeah, but I don't really factor that into my thinking. I use supply and demand. So as soon as one of those change, if I'm paying attention and trading the math, as soon as one changes, I'm out. And if I've got my 2% or 3%, if I've captured all of the intraday volatility, I'm out. I can return to the same thing tomorrow or the next day. Doesn't mean I'm day trading. It's like if that could be 2 or 3 days. It's neither day trading nor swing trading. It's trading supply and demand. It's just that the life cycles in the stock market are very short because so much of the trading volume is set by machines which have an investment horizon of a day or less. They're 53% of all trading volume. Routinely in small caps, they're 68 to 70%. And so it's more dangerous to trade small caps because of that. There's a greater concentration of them. If you look at, this is Boeing, right? Boeing, it's a much bigger company, less volatility, less chance for machines to cause your gains to evaporate. You probably have a little more caution. But that's what volatility is already going to probably tell you that. Okay, last question. Good questions, you guys. Okay, what did I miss? Is there anything Joe, how do you use this tool to make stock selection, and what is your search criteria? So Joe, I'll finish with that because that's a very good question, and if I missed you, I'll go through the chat. And my email, tq@marketstructureedge.com, tq@marketstructureedge.com. I reply to everything. Sometimes, as you know, it takes me a little bit, but I always will. On your dashboard, what we try to find for you, this for instance, right? This is one I'm experimenting with. So it's diverging supply and demand. So I've got it looking for everything without respect to trade size. So I will sort by trade size. And believe it or not, to be in the 1,000 most liquid stocks in the market, you got to be a little bigger than this one, home bank shares. You have to be about $3,000 per trade. That's not volume, but it will give you a pretty good clue on whether the spread will be narrow or not. At 4,200, the spread's pretty thin. Both of these are, 3, 4, 5 cent spreads. So I like to find liquid stocks, reduces my risk. I prefer larger ones than all that broad sentiment, context divergence, and then I want to trade these things, the supply demand divergence. If this is rising and that is falling, more, 90+% of the time, that is going to give you a very high probability of a short return. We're not looking for 100%. Well, I'm looking for 2 or 3%, 1, 2, or 3%. But if you do that over and over, you will become rich, and you will not lose money. And that is far better than saying, well, we believe there's going to be a 10-bagger in this crypto stock. On what basis? This is reliable. So that's how we do it, Joe. All right, you guys, great questions. I will do this again. I realized I'm going to be challenged on the 27th because I'm on the road. I'm headed to Charleston. We'll be in Charleston for the month of November, but I'll do these the whole time while I'm there. So I'm going to have to check the 27th. I might have to move it up, but I think it should work. I think it will work from where I am. But please come join these, and we'll continue to do this to help you use the platform. And long timers, great to see you. New folks, thank you for coming, and I'll catch you the next time.